You can't start.
Oh no.
Our entire team has spent the day looking into the problems that you've been sharing with us. We start with Caitlin Ross, who's spoken to voters about their frustration.
Hello.
Welcome, everybody.
Good evening.
Good evening. I'm going to ask you, if you don't mind, to place yourself on mute while we get started. Thanks. I am just steady bringing people in. Thank you all so much for joining. This is going to be our second installment of House Rules for Home Ownership. How to choose a mortgage loan officer is what we will talk about tonight. And I am Michelle Lewis. I am with Invest Atlanta. I am the home ownership and community engagement specialist in the community development division. So welcome everybody. Thank you so much for joining us this evening. Before I introduce you to the best home ownership team in the world, I just have a few housekeeping items that I want to go over. First, if you don't mind putting yourself on mute, that will help us out a lot in getting through everything. Making sure that everybody's muted just kind of gets us through all of the process pretty quickly. And it's, of course, less distractive. We're going to allow you guys to answer or ask questions, and then Russell, of course, will answer those questions for you. But we're going to do that at the end. So the best thing to do is to either type your question into the chat, and we will, of course, read those on your behalf for him to answer at the end. If you're watching us on Facebook Live, you can enter those questions in on the comments, and we'll be looking back and forth between the two. Trying to see you raise your hand or use the raise your hand mechanism is going to be really difficult. We had over 300 registrations for this, so it's going to be pretty difficult. The best way to do it is to, of course, use your chat. Now, if you're on the phone and you don't have access to the keyboard, then that will be the exception. You'll have to let me know by raising your hand, and I'll scan to make sure, but that would be the only exception. So without further ado, let me introduce you to the best homeownership team in the world. I'm going to start with Felicia. Felicia is here with me. I can't really see anybody right this second. Felicia, you on mute?
Hi.
Okay.
Hi, I'm Felicia Neal. I'm your mortgage loan coordinator. Welcome to our second session. So get ready to take some notes because I know our speaker is going to be dynamic. So again, welcome.
Awesome. Then I'm going to introduce, is Kirsten with us?
Not yet. I don't think so.
Okay. All right. We'll come back to Kirsten when she's able to log in. But I will go straight to our leadership, our boss lady. She is our director, and she is Anita Allgood.
Hi, everybody. Thank you so much for being here in honor of National Homeownership Month for our second session of House Rules for Homeownership. We hope you get some great information from the session. I'm certain that you will. And please plan to join us for the next two sessions as well. Thanks again.
Awesome. Thank you so much, Anita. And I know that you will do the honors of introducing our guest.
Yes. So we have with us today Russell Elam. Russell Elam is with Geneva Financial. He's been in the business, and Russell, please forgive me because I don't have your bio pulled up, but I know Russell's been in the business for probably 20 years or going on 20 years. Russell is one of our top producing loan officers year over year over year. Not only is he just a fantastic loan officer all around, but he is extremely well versed in our down payment assistance programs, as well as all down payment assistance programs across the city. And so we are very happy to have him here to provide insight on the mortgage industry, how to select a loan officer, and all of the best practices that you'll need to know to have a smooth transaction with your mortgage. So welcome, Russell. Please take it away.
Thank you, Anita. Thank you, Homeownership team. Again, as Anita mentioned, my name is Russell Elam. I'm a mortgage loan originator with Geneva Financial. As she stated, I've been in the business for 20 glorious years, and I love what I do. I've been doing it ever since college. The main thing is that it provides me to be with people and numbers, and those are my two things that I feel like that are gifts that God gave me to be able to help people become homeowners. So would love to, I'm happy I'm here today talking to you guys to kind of give you some insight about how to pick a mortgage loan originator, because there's a bunch out there. There's some very good ones, and there's some ones you could possibly stay away from. And so hopefully I can give you some tips on how to kind of weed those out. Okay. And so, Michelle,
You ready for me to share the screen? Awesome.
Yes.
Okay.
Okay, so the first question is, what is a loan officer's job? And so when you think of a loan officer, I'm pretty sure you've probably heard of various different things in regards to what they actually do. And so what I'm hoping to do today is kind of give you a breakdown of what they do and how you can try to choose one that will be very easy for you to deal with, and have your best interest at heart as you go forward with trying to purchase a home. Okay, so the first thing we want to talk about a loan officer's job is evaluating credit worthiness and eligibility of a buyer. And so evaluating credit worthiness kind of starts with an application. And so right now, as you well know, in our world today, we're very technologically advanced. So most of your applications are going to be done via the internet. There are definitely some situations where someone can walk you through, take an application over the phone. However, the key to getting a mortgage quickly is speed, and you filling it out at your leisure on your own time typically helps speed up the process. So most lenders and most loan officers will want you to go to their website to complete the loan application. And so that's basically the first thing you want to do, because that allows us to evaluate the credit worthiness. Because what we're going to do is we're going to take that application and we're going to pull credit. Okay. And pulling credit is really the first, I guess I'll say, line of defense for a lender to figure out whether you're going to be accepted to get a mortgage loan. And so there's many different lenders out there that have different credit score requirements that will help you become a homeowner in the future. And some of the credit scores can be as low as 500. Currently with COVID-19, that's not something that's very active right now, but eventually we'll get back to that hopefully next year. But typically on a conventional loan, which is through Fannie Mae or Freddie Mac, that particular loan is a minimum of 620, and that's across the board for every lender. So in that case, you have to have a 620 to do a conventional loan. And so that's kind of what I'm looking for when I'm looking at that particular loan type. Now, also another popular product is an FHA loan, and that is where it kind of varies from lender to lender. One lender may be 580, another lender may be 550, another lender maybe 600 or 620. So, based on your scenario, if you have a higher credit score, then those type of things don't really matter to you. But if you have a lower credit score, that may be something that you want to kind of weed out a company and a loan officer, because if they can't do the credit score that you might have or that you've checked to have, then you really don't want to waste your time with going through their process if that's not something they can do. And so that's one of the first things that I want to do is evaluate. So the credit score is the first thing that I look at. Okay, if your credit score is not there, then we want to talk about, you want to have a loan officer that calls you back. I've heard it so many times, countless times, where I've had clients say, well, they pulled my credit and never heard from them. Well, obviously, if that's the type of loan officer that person is, then that's not the type of person you want to deal with. And what a loan officer should be doing is telling you, hey, your credit isn't where it needs to be right now. However, here are some steps that you can take to get you in position. And sometimes those steps can be very quick. I mean, it could be a week and you could be in position. Other times those steps could be, a month, 6 months, even a year. But the key is that loan officer is giving you some feedback into making those steps become a reality. Because just because in this particular scenario, you can't become a homeowner now because your credit score isn't where it needs to be, that doesn't mean that can't change in the future. So you want to, hopefully use someone that is going to help you through that process if you fall in that category. Okay. And so one of the things we're doing as a loan officer, and this does take some experience. So I know sometimes, unfortunately in this industry, there may be a newer loan officer. And so the credit worthiness part of it's, if they don't have experience with reviewing credit and the nuances of credit, sometimes that could be to your detriment. Again, we're talking about credit challenges. If you have perfect credit, then of course this conversation right now isn't for you, because you're credit worthy. If you got a 750, 800 credit score, 700 credit score, then more than likely, we're not going to have to dig too deep into your credit. This is for those individuals that have, moderate to lower credit scores, where evaluating the credit will be at a premium for the loan officer to be able to do for you. And then when it comes to, the other part of that is eligibility of a buyer, that's the part that comes in with reviewing your documentation. Just remember, this process is heavily documents. There's gonna be documents flying everywhere. You may get paper cuts of so many documents, but realistically, you just got to know that that's part of this process. So going into this, you want to make sure that you are on point with your documentation, because that's half the battle. If a loan officer has that information and they have all the correct information, they can guide you through this process pretty smoothly. Meaning, if they ask you for something and you give them something else, that kind of makes it tougher on a loan officer. So, the eligibility part we're talking about is like looking at reviewing your pay stubs, reviewing your W-2s, reviewing your tax returns, reviewing your bank statements, because there's a lot of different things that go into those items that the underwriter is going to review. And so a loan officer's job is try to pick those things out on the front end, so if there's any explanations that need to be written out to the underwriter when we turn the file in, those things are being addressed on the front end, because what the loan officer should be trying to do is to make sure there's no surprises. They're trying to make sure that this process is as smooth as possible for you by reviewing those documentations. Because I've had clients in the past say, well, this other lender didn't make me turn these in. In my estimation, I would run from that lender, because they're not doing their due diligence, which means they're not helping you to ensure that your process is as smooth as possible. Because if you turn something in regards to eligibility, and I see that there is a potential pitfall, we can address it now before you have a contract. You don't want to try to address pitfalls while you're in the contract stage, because that just gives everybody anxiety, and that could cause delays and things of that nature. So, what a loan officer's job is to make sure that they review your credit and they review your documentation. But again, there's some online lenders out there, and there's some individuals who don't take those additional steps. And again, I think that's important in order to make you feel comfortable and make sure that your scenario will work for that particular lender. Okay. And that kind of runs right into educating the borrower. Educating the borrower is more than just giving them definitions, but it's basically breaking down all the different various nuances in regards to purchasing a home. And it's repeating those steps. This process of owning a home is pretty much the same with everyone. As an example of, We all have to get our credit pulled. We all have to turn in documentation. So educating the buyer is basically saying that as I'm reviewing those documents and just kind of explaining to them, this is why we're doing this, this is why this is needed, and continue that through the entire process. You know, you want to be in a situation where the loan officer is in constant communication with you. And that obviously doesn't mean every day, but that just means that they're keeping you abreast throughout the processing of the loan of what's going on with the mortgage loan. Okay. And so that's the same thing as guiding you through the process. This process, I like to explain it to my clients. If you're saying your ABCs correctly, A, B, C, D, E, F, G, just like this process, that's how it goes. So meaning that you can't say A, B, F in order for this process to be smooth. So sometimes things that may be going on right now could affect something down the line. And so as a loan officer, my job is to make sure that I'm looking out for those particular instances and things that could come up later down the line, right? And so as I'm guiding you through the process, and they should be able to, they should be able to explain that to you on the front end. They should be able to give you an overview of how they operate and how their company operates in order to justify exactly how they're going to make sure that this process goes smoothly for you. Okay, Michelle, could you next slide? Okay, so the next question is, what should home buyers expect from loan officers? Well, number one is going to be communication. You have to be able to communicate as a loan originator to your buyer, and that communication varies from client to client. I've had clients here recently. They're like, Russell, I'm sorry for calling you 6 times a day, but I just had another question. And I'm like, hey, listen, I'm here for you, right? And that's what the loan officer should be. They should be here for you. So if it takes that type of, I guess, for lack of a better term, hand-holding, then that's what's required. And so giving you that communication that you need to feel comfortable and to make sure that you understand where we are in the process and where we're going is key with communication. And sometimes that's, nonverbal, meaning that it's done through email. It's not always going to be a conversation. But the key is making sure that they communicate as we move through this process. And so, if you have, a big trouble with getting a hold of your loan officer, through all the various sources, not just calls, because I can tell you as being a successful loan officer, I'm always on the phone. My phone is always ringing, so I can never get back to everyone all the time as quick as they would like sometimes. But the key with this is that if you give them a couple days, or if you've tried it, 2 or 3 or 4 times and they're still not getting back to you in a timely fashion, then that person may not be the perfect person for you because the communication is lacking. And, again, some clients need a little bit more communication. Others are kind of, hey, you communicate with me once a week, and that's perfectly fine. So, it just all depends on your comfort level. You want to also make sure that they're knowledgeable. And knowledgeable means that they have a good understanding of all the different loan types that are out there, such as VA, USDA, conventional, and FHA. And not only just knowing those products, but knowing all the different pitfalls of those products so that you can make sure that you are well taken care of. Kind of give you an example on an FHA loan. Student loans is always a big topic and a big issue. And so if they don't know how to address that in a way to help you qualify, then that could be something where you could have issues. And that's where you want to ask, multiple lenders, hey, I got student loans. How would you work that into your approval, your pre-approval? And they should be able to kind of break that down for you depending upon your scenario and your situation. And that's a conversation you can have with a loan officer before they pull your credit. That's a conversation you can have before you send any documentation. So that kind of helps you weed out potential loan officers that may not have experience with that particular scenario that affects you the most. Okay. And, again, what should homebuyers expect from loan officers? Accessibility, kind of hit on that earlier, but the key is that you want them to be able to be there for you through this process. I mean, as we all know, this is more than likely going to be the biggest, largest transaction you make in your lifetime. And so you want someone to be accessible for any questions, any concerns, anything that you have that you want to point out in regards to your scenario. they need to be available. And so that doesn't necessarily mean, again, every single day, because sometimes, I have clients that reach out to me on the weekend and, we're closed on the weekend. However, I tell them all the time that on the weekend, if I'm just sitting around and not doing anything and my children are asleep and the text or the email or the phone call comes, then I'm going to answer it because I want to help you reach your goal. And that's the bottom line. That's why I'm in it. I'm in it to help you reach your goal. And that's how the loan officer should feel and should think. Now, don't get me wrong. There are a lot of loan officers that say, hey, the weekend is kind of off limits. That's for my family. And that's perfectly fine as long as they're giving you the communication that you need and they're getting you what you need so that you can move forward on purchasing a home, then I think that's acceptable as well. All right. And so, Michelle, next slide, please. Okay, what should loan officers expect from home buyers? The main thing that I would say is follow the loan officer's direction. And what that basically means is that typically a loan officer will send you a checklist or some type of form that basically outlines what they need from you, and you want to get that to them. And anytime, you also want to make sure and be steadfast in sending exactly what they requested. So for instance, if they say, hey, I need your bank statements and I need all pages, and there's one of 10 and you send the first 8 because the last 2 are blank, that's actually doing the loan officer a disservice. So you want to just make sure that you give them as much information as possible as far as what they asked for. And so that helps them make your process that much smoother. And I get it, I understand, but you want to think about this again. This is the biggest transaction to you. Is a very large transaction for the bank or lender. So the proper paperwork is typically necessary. And I've kind of heard this before in the past as well. Well, I know someone who said they didn't have to do all these things. Everybody's situation is unique in a way to where sometimes we have to ask for certain things from one buyer, and the next buyer we don't have to ask for the same items. So just remember, if the loan officer has your best interest at heart, and they definitely want to make sure that your loan closes on time. So whatever they ask for, you want to just make sure you get it to them as quick as possible. Okay, and that kind of goes into the same thing. Send the specific items required by the loan officer. It's just, again, I can't reiterate that more, because the people that are always close on time or ahead of schedule, a lot of times it's because the buyer is on it in regards to the paperwork. And I get it. Sometimes individuals have employment to where they don't have access to be able to send things while they're at work. But the key is just obviously when you are able to do it, that you send in the exact information that's requested. And that's kind of the bottom line there. And then the next thing would be accessible. What loan officers are looking for from their clients is accessible, because this process typically, a lot of times, depending upon if you're doing a regular loan, if you're doing a down payment assistance loan, you're getting 30 to 45 days. And what I've seen a lot from realtors recently is that sellers don't want to give the 45-day time frame because they have multiple offers. Helping close the loan faster is you being accessible and getting the documentation back as soon as possible, because it's not possible for a loan originator to ask you for every single thing up front that's going to be needed. There's a certain standard, and then as you process the loan, there's going to be things that come out or come up that need to be addressed during the loan process. And what I tell my clients, in order for us to close on time, I really would like to see you give that stuff back to me within 24 hours. Now, again, I get it. Some people don't have the access to do that or the capability. However, I do know for the people that do and are able to do that, then we always are finished ahead of schedule. Okay. And then what's involved in the timeline when purchasing home. So this is kind of a little step process that I compiled to kind of give you a little bit of information on the timeline, exactly what goes into that 30 to 45 days that I just mentioned. So the first step is the mortgage pre-approval. That's the part where we want to review your credit and your financial situation. So that's obviously me pulling your credit, the lender pulling your credit, the loan officer pulling your credit, and then reviewing it. And then telling you, hey, these are the disclosures or documents that I need in order to verify your income and assets. So then we can talk exactly where you stand in regards to what you qualify for. And a lot of times what I've found is that, I want to tailor the pre-approval to your specific needs. And so that means what type of questions is the lender asking? Are they asking you what your budget is? Because if they're not, it's kind of important when you're talking about a mortgage loan. Yes, you may qualify for $400,000 on paper, but do you want to make a $3,000 mortgage payment? Sometimes the answer to that question is no. So what a loan officer should be doing is breaking it down to your specific scenario. What part of town are you looking to buy? What monthly payment would you like to stay around? You want to make sure that the loan officer is asking those types of questions, because if they are, then they're really in tune to you and what you're trying to accomplish. Okay. And then once, let's say you've turned everything in, the loan officers reviewed your credit, they reviewed your financial situation, they said, okay, based on what you're trying to accomplish, this is how much you're pre-approved for. And they present you with a letter. That letter typically goes to you and your agent, and then you and your agent take that letter to start house hunting, which is the second step. And of course, what you're doing with that step is to try to find a home that you love so that you can make an offer. Okay, making an offer is basically taking that pre-approval and signing a contract and sending it over to the listing agent, the seller, to hopefully get a signed contract back, right? And so the key to that, as far as timeline, when you're talking about that, it really boils down to how long does it take you to locate a home. I've had clients do it in a couple of days. I've had clients take 6 months. It really depends upon your flexibility and what's out there on the market. Because obviously, being a homeowner myself, is just impossible to get everything that you want in a home unless you're building it from scratch and you got an architect and you're telling the architect what you want. So the key is just to be flexible with that, and just obviously get what you love, because you're going to be the one that's paying the mortgage once everybody else is out of the picture. So once you sign that purchase agreement, so you signed it, you made the offer, you sent it over to the seller, and the seller says, yes, I agree to your terms, let's move forward, which is obviously a great thing. So from there, that purchase contract needs to come to me as soon as possible, right? Because what that does, it allows me to move forward in the next steps of the process. Because at that point, I'm kind of just sitting back waiting for you. Now, I do have some clients that will send me over properties that they want to make an offer on to kind of get an idea of what the payments are on this particular property. And so that's another thing that a loan officer typically does, is that we will run numbers for you on certain properties to figure out exactly if this property fits within your budget. And so that third step again is, now that I got the contract, I'm going to take that contract and I'm going to enter into the loan operating system, which will allow me to produce disclosures and documents for you to review and sign to say, hey, this is what the payment's going to be. This is what the interest rate's going to be. This is how much money I have to contribute at closing for appraisal, and all those different variables there at the onset of the contract. And then once you sign and get those documents back to me or to the loan originator, we're going to be looking to turn that in for mortgage processing. Okay. And so, of course, in order to do that, we got to have the fully executed contract. And at that particular time, depending upon the time frame it takes for you to get under contract, we may need updated items such as bank statements or pay stubs or things of that nature. So, we'll be asking for those things as well, so that we can turn it over to the mortgage, our process, or actually mortgage processor. And so from there, she'll start ordering all the things that are required for underwriting. Part of those steps are, ordering the appraisal. Typically, 99% of lenders that I know, they're going to require you to pay for that appraisal at the time of order. And of course, the processor orders that for you. They order the title commitment. They order your verification of employment, all the third-party items that are required to be in the file for the underwriter to review for your approval. That's kind of what she's working on at that stage. And so there may be a lot of back and forth. There may be some things that we have to get from you, and just be wary of that part of the process, that you are in this process the whole entire time. And so I've had some clients in the past that thought that, hey, this process is more like I give the first initial information and I kind of sit back and wait for closing. And that's not the case. This case is kind of like, I'm the captain and you're the co-pilot, and we got to make sure that this plane lands smoothly together. And yes, I'm more heavily involved as the captain, but it's definitely a team effort as we move through this process, okay? And that kind of leads me to my fourth step, mortgage underwriting. The mortgage underwriter is kind of like the traffic controller. They're actually the ones pulling all the strings. They tell us when we can land. So it's our job to make sure we're doing everything and put everything in the file that they want to see so they can get us that final approval out as quick as possible. Okay, so the mortgage underwriting stage is kind of where we have the minimum items that's required by a lender. And so that kind of varies from lender to lender. But once you have those minimal items, the file gets turned into underwriting, and then there's a time frame for that to be reviewed. Currently, sometimes it's 24, 48 hours, sometimes it's up to 4 or 5 days, depending upon the lender and depending on how busy they are at that particular time when you submit your file. Okay, and so what we're looking for at that particular step is once it's submitted, the underwriter is going to review it, and they're going to come out with what's called a conditional approval. For the most part, sometimes it comes out clear to close, but most of the time it comes out with a conditional approval saying, hey, I'm the underwriter, I reviewed your file, it looks good. However, for me to give you the final clear to close, I need these several documents or these several items. And so once we gather those items, and sometimes that's quick, and sometimes it takes some time to get those items, but once we have those items, we then turn that back into the underwriter for what's called a final approval clear to close, which is the fifth step. Okay, and so once we got that final approval, comes out, now we're ready to move to the closing department. Okay, the closing department then works with the closing attorney, and they make sure all the numbers and figures are exactly where they need to be in order for the numbers to be accurate for closing at that closing date that was listed on the contract. Okay. And so that's kind of the timeline of what major steps are in that. And again, it depends on the type of loan that you're doing. It depends on how quickly you get the documentation and you stay involved and engaged in the process on how quickly that can move. Again, I mean, I've closed a deal as quick as 5 days. Obviously, that was an anomaly. Typically, the quickest time frame is going to be 2 weeks to 3 weeks. And then again, if you're using down payment assistance, sometimes it takes 30 days. But the key is asking for the right time frame, setting the right time frame expectation up front, because we never know once we get into processing a loan what's going to pop up or what's going to happen. So that's the reason why at the events that Invest Atlanta has and other various down payment assistance, they say you want to get 45 days. It's because we don't know what's going to pop up that's going to deter us or delay us. So, it's kind of like turbulence on a flight. You get on a flight and you don't get on there expecting turbulence, but sometimes it happens. And so, as a good pilot, a good captain, we got to navigate that. And part of that navigation is letting you know up front that we need to set the right expectation. Yes, it can be done in a quicker time frame. However, getting the amount of time that's required and closing early is the better option, because when you're not closing on time, it definitely causes people a lot of stress, unnecessary stress, in my opinion, anxiety and things of that nature, when we could have easily just said, hey, give us 45 days, and then we're ready to close in 30 days. Everybody's excited and happy. Next slide, please. Okay, let's talk about definitions. So definitions, these 4 items here listed are critical in discussing a mortgage loan. Got to have all 4 in regards to buying a home. And so the sales price is going to be the number that you and the seller come up with to determine the price of the home. And so, the list price could be $300,000 and you offer $285,000 and the seller says yes, or the seller says, no, I would rather take $295,000, and then you say yes. But once it is agreed upon what that number is, the sale price of the home, that's basically the definition of it. That's going to be the price that the home is going to sell for. Okay. And then the next one we want to talk about is down payment. The down payment is money that you're required to contribute in order to get the mortgage loan. The typical loans that we're doing in Metro Atlanta are going to be conventional loans and FHA loans. Conventional lending requires, at least a minimum of one of their programs requires down to 3%. Okay. And FHA is down to 3.5%. And so 3.5%, and let's do easy math. Let's say $100,000 sales price and the down payment is 3%. that means you got to have $3,000 to put down on the home. Okay. And so that leads into the next definition, the principal loan amount. So whatever you put down, subtracted from the sales price, will give you the loan amount, and which is also the principal balance. It's another term. Some people call it principal balance, other people call it loan amount, but that's how you get to that loan amount, that principal balance. And then lastly is one of my favorites to cover, because so many loan officers and people in this industry get this wrong. The buzzword is closing costs. Well, what goes into closing costs is not just closing costs. It's also prepays, which happen to be, property taxes, homeowner insurance. It's your escrow account, basically. And those two things are very different. And so when people talk about closing costs on this loan are $7,000, that's just not an accurate representation of what the numbers really are. They should be saying the closing costs are $4,000 and the escrow prepays are $3,000. And the reason why I think that's important to differentiate is that once you close on your home, there's no way to get your closing costs back, because you closed on the home. Everybody that was paid deserved to be paid for whatever reason in regards to the purchase of the home. However, that escrow account, those prepays that you're putting in, is your money. It's just being set aside to pay items later for you in regards to your property taxes and homeowner's insurance. So it should be a distinction between the two. So if your lender or your agent is saying closing costs, or your lender just saying closing costs, we want to make sure that they're giving you the right information, because there definitely are two different things. I love to give this analogy, is that if you turned and hit the lottery after closing and you paid off your mortgage, you would get zero closing costs back. However, they would send you back a check for your escrow account, because you would no longer need it, because there would be no mortgage. So that's the complete difference of what those two things are in regards to closing costs and prepay. So that's one of the things that I love to kind of help you weed out a good loan officer. They should be telling you that, should be breaking that down to you, because it's important to know what that is. And so sometimes you say, because you'll hear, well, the closing costs seem a little high. Well, they're not really high, because the closing costs are truly only $4,000 in this example, but the prepays for the property taxes are $3,000. So again, it's just important to know the difference between those two. Okay, next slide, please. Okay, how much should home buyers set aside to bring to the closing table, and why? Now, this is a great question, and it's actually a tough question to respond to, because everybody's situation is going to be unique and different. However, I will say this: the days of buying a home with no money in your bank account is a thing of the past. So we want to make sure, and you want to understand, that you have to have some skin in the game. Albeit, if we're speaking Invest Atlanta's program, they require you to contribute at least $1,500 of your own funds. And so if you contribute $1,500 of your own funds and you have no other funds after that, then that may be a tough situation for you, because as we homeowners know, that things always pop up being homeowners. So you want to make sure that you have set aside as much money as possible. But the key is that that conversation is going to be individual with the loan officer, because they're going to give you exactly what's required for the loan. But I want to give you two ways of thinking about this. You don't want to just have what's required of the loan. You want to have additional money in the bank, because as a homeowner, things always come up. Things always need to be taken care of and need to be fixed. So it's just important to know that. And so that there's not a specific dollar amount out there blanket for everyone. But of course, the more money you have, the better. And so it's really, again, a conversation you want to have with your loan officer specifically on how to make that work. But when I explain to my clients, I explain that to them, like, hey, we can make this work with what you have in your bank account. However, just so you know, what the underwriter is looking for, they're looking for additional assets. However, the loan still works. And just for your own purposes of being a homeowner, you want to have those reserves, so for anything that may pop up later down the line. Okay. And so I kind of like to break down, how do we know what we need to set aside? Like, how do we know how much at closing that we could potentially need? And so it's kind of like a debit credit, ledger scenario, and kind of break it down right there. Tells you, purchasing a home consists of three main components: as it relates to home buyers. And what I mean by that is that if you're looking at one side of the ledger, you have the cost to buy the home, okay? And I'm just going to kind of give you all the costs. And this is the same for every lender, every bank out there. You agreed upon a sales price, so that's how much you have to pay to buy the home. And let's just do even numbers, 300 grand, right? And let's say your closing costs are 3 grand, okay? And then your prepays are another 3 grand. So the total for you to buy this home is going to be $306,000, okay? The good news is that you qualify for a mortgage if you're pre-approved, right? And the mortgage is going to take some of that off, right? So you got the 306. So it's like, again, it's 2 columns. You got the column of how much it costs, and then you're going to have the column that you get to subtract. And so things you get to subtract is going to be your earnest money is going to be subtracted out of that. When you pay for the appraisal, will be a subtraction. The down payment assistance, if you qualify, will be a subtraction. The loan amount, of course. And so once you subtract everything from the column with the sales price, closing costs, and prepays and escrow, if that number is a positive number, that means you still have to contribute money to buy this home, because the total is 306 and you haven't contributed 306 through the loan, through the down payment, through paying for earnest money and what have you. So that's just a way to think about how it works in regards to the totals of buying a home, because I know through various conversation experiences with clients, you know, they always want to know, well, how did you come up with that number? It's easy math. Sales price plus closing costs plus prepay / escrows. Subtract loan amount, subtract down payment assistance if you get it, subtract earnest money, subtract if the seller's paying any closing costs, and then, you know, paying for the appraisal. And then of course that bottom number is going to be whether you need to bring money to the table or not. Okay. And the next screen, please. Okay. So one of the questions I get a lot in this current environment is COVID-19 has definitely caused some pressure on our industry as it relates to investors basically walking away from a lot of the specialty programs that are out there. So, you know, as far as specialty programs, kind of hit on those real quick. So, like bank statement loans are kind of a thing of the past, and you know, it's very few lenders that can offer renovation loans, not many that I know of at all. And so things like that have kind of have been deemed high risk, and so a lot of lenders have kind of moved away from that. And also too, it's been tougher for lower credit score buyers as well. You know, a lot of lenders, my lender included, you know, we originally used to go down to like a 550. And when COVID-19 hit, a lot of the investors backed away and said, hey, you know what, we're no longer accepting those, because obviously what happens in their mindset and on paper is that people with lower credit scores tend to default more on their mortgage. And so they kind of moved away from that, as far as, you know, now our minimum credit score is a 620. That's a big difference. You know, 550 to 620 is a big difference in regards to your lowest credit score. So a lot of lenders have taken that initiative and kind of moved away because investors just won't buy that program or product anymore. The other thing that's kind of been different in regards to, I don't have it on my slide, is your employment. They're looking at your employment a little bit more closer, because if you're in an industry that was heavily affected by COVID-19, meaning as things happen and your hours reduced or your pay was reduced, they're going to look at you know, your file a little bit tougher, to be honest with you. They're going to be looking at your file to make sure they're making a sound decision on granting you the loan. You know, if you were someone that, you know, nothing stopped and you just moved from working from your office to your house, then they're not really looking at you closely. But for those individuals who were highly affected by, again, loss of income or reduction of income rather, or, you know, reduction of time at work, then those can still be done, but they're just going to be looked at a little bit tougher. So that's something that you want to share with your loan officer up front, because they should know their guidelines. And if they don't, again, that's another cue that loan originator may not have the experience or the wherewithal, the know-all in order to process your loan efficiently. And so those are kind of the main changes that the COVID has kind of put out there in regards to, you know, qualifying for a mortgage. It's definitely a little bit tougher. You know, a lot of investors have kind of suspended their programs or put them on hold to kind of see what's going to happen with the U.S. economy and you know, everything in general in regards to the COVID-19. Okay, and next slide, please. Okay, so lastly, I just wanted to, give you my contact information, because what I always tell my clients is that, or anyone that I know, that I love what I do. And so even if you're not using me, you can always reach out to me and shoot me a question. If you don't think what your current lender is saying is accurate, or they may not have the experience with that, you can bounce it off me. I'm not gonna say I know everything, but I do know a lot. And I've definitely worked with a lot of clients, and I know a lot of peers in the industry, and I know their programs. And so anytime I've had questions, or I had a client that may not have worked under my plan or what I'm able to offer, and I know another lender out there can offer them something, I'm more than happy to refer them over. I don't get anything out of it. However, it's just another buyer in the market to me. And so I think helping people, is what I think is important. And that's kind of what I live by. I live by the golden rule. I'm gonna treat people as they treat me. And so I'm gonna treat people to try to help them as much as possible, whether they use me or not. So I would love to, I guess, open this up for answering questions.
All right, thank you very much, Russell. That was awesome. I'm just going to start in the Zoom chat and begin to answer questions from there. Let me get myself together because my screen just changed up on me. Where's my tab? There it is. Okay, and so continue to put your questions there, and then I will then move over to the Facebook chat as well. So starting at the top from Jesse Whalen. So you might cover this. How do you shop for a loan officer? And I think you did cover that. And then he says, I understand the good faith estimate is no longer used. Correct?
Correct. So yeah, a few years back, I think it's 2015, our industry changed over to a loan estimate. So it holds the same significance as a good faith estimate. So typically you get that if you have a contract on a property. If you don't have a contract, the lender should definitely be able to supply you what's called a fee worksheet to kind of give you an idea of breakdown of what those items are. And that's typically what I do, and most lenders will be able to do that pretty easily, send you over a fee worksheet, unless you have a actual contract or address on the property, then they can send a loan estimate.
Okay. So does a collection prevent a person from getting a loan?
No, it does not prevent someone from getting a loan. There are definitely guidelines depending upon whether you're doing an FHA loan or a conventional loan. I guess the answer is that it could. However, the key is to make sure that your lender is going by Fannie Mae, Freddie Mac, or FHA guidelines, and they don't have overlays. And what that overlay means is basically they've taken the guidelines that have been giving out to the investors, and they've made it tougher to get a loan to go through. And so they've just added additional guidance to mitigate the risk for their particular company. However, another company that goes directly by Fannie Mae, Freddie Mac, FHA rules, and those, as far as collections are concerned, it may not affect you. So if you're in that predicament, that would be the first question that I ask the loan officer, is that, are you going strictly by Fannie Mae or Freddie Mac if you're doing a conventional loan, or if you're doing an FHA loan or a VA loan? You want to ask that specific question. What does the guideline say? Or do you have your own guideline? Okay. And then if that person says, they should be able to send you the guideline. And that's what I do a lot of times. I don't think I think my clients are all pretty intelligent. They can read. So what I typically do is say, hey, here's the guideline. I emailed it to you. This is what it says. So I can do it, or I cannot do it because of this.
Okay. How do school loans play a part in your eligibility?
Great question. Great question. Yeah. So school loans it's a couple different things. You want a lender who knows how to navigate that, because depending upon how you have that set up, meaning, are you in deferment? Are you in forbearance? Are you in school deferment? Are you paying a income-based payment? Are you paying a regular payment? Depending upon, or do you have a zero payment? Depending upon how your student loan is set up, they should be directing you as far as the loan type it goes. So kind of give an example. Conventional loans, they allow, which is backed by Fannie Mae and Freddie Mac, they allow us to use an income-based payment. They allow us to use a zero payment. The key is that that is the actual payment from your student loan company. So you would basically supply a statement that says, I have this amount of student loans and the payment's due July 15th and the payment is zero. If that's the case, then the lender should be able to accept that. If they don't accept that, then they're not following the guidelines as Fannie Mae has written them. Freddie Mac's a little bit different, but Fannie Mae accepts a zero payment. And then FHA is a little bit different. FHA loans a little bit tougher because they require, they have two ways to get around it. So if you have one of those situations where you are paying an income-based payment and you don't qualify for conventional, FHA is not going to accept that. They're going to accept 1% payment of your balance, meaning if you have a $50,000 student loan, 1% of that is going to be $500, right? And so $500, a loan officer or lender would have to input that as your payment, even though you're not making it. That's what we have. That's what we have to enter because FHA, the investor, is saying that that's the way it is. However, if you have a savvy loan originator, they should be able to direct you on the second piece of that, which means that FHA will allow the regular payment. And so sometimes the regular payment with no strings attached, meaning has nothing to do with based on income, it has nothing to do with any type of graduated payment or deferment, anything like that. It's just, hey, I owe 50 grand, here's the interest rate, here's the term, and this is the payment. You can use that. And a lot of times that payment is a lot less than what the 1% would be. And then they should be able to hopefully get you under the debt to income ratio requirement with that. And I've definitely used that on many occasions. I have several clients right now that I'm using that. So that is something that's workable.
So let me just add on to that because you didn't really talk about the debt to income ratio requirement. What is that exactly?
Okay, so the debt to income ratio requirement, it depends on the type of loan that you're doing, right? If you're using a conventional loan, they have a max 50%. FHA, and 50% of your gross monthly income. And so to kind of give you a quick math, if you made $5,000 gross income a month, 50% of that would be $2,500. Okay. And so what that means is that your minimum monthly payments on your credit report plus the new mortgage payment has to be less than that $2,500. So a good rule of thumb is you take that $2,500 and you first subtract out all your minimum payments on your credit report. Okay. And then whatever's left over is enough. It can be used for the mortgage payment. And so that's how debt to income ratio is calculated. And so it just kind of depends on the type of loan that you're doing, whether it's 50% or whether it's 55%, or if you're using a specialty program like AHOP is 43%, or some of the programs in the Best Atlanta, FHA is 45 and conventional is 50, of course. So, you know, it really depends on your particular scenario that you're going to be using to get you qualified for a mortgage loan.
Thank you, sir. So how long do you have to be out of a Chapter 7 before you can start looking to buy a home, a Chapter 7 bankruptcy?
Okay, that depends on an FHA loan because conventional lending, and kind of talked about the differences there. A conventional loan, they're going to be a little bit tougher on discrepancies that have happened in your past. Their timeframes are longer for everything as far as the questions that you're asking. So typically when you have this type of question, the first thing to do is to go look at FHA's guidelines. And FHA guidelines says 2 years. So you're looking at 2 years in regards to being able to qualify for a mortgage. And just remember, meeting this time frame doesn't guarantee it. It just says that you've met the minimum time frame outside of where you need to be in regards to the bankruptcy.
Great, thank you. So next question is United Community Bank a lender? And so the answer to that question I'll answer is no, United Community Bank is not one of our participating lenders. You can see those lenders on our website. When you go to our website and you look at the 5 steps that we outline using our incentives, in step 3, there is a link to all of the lenders that are participating. And Russell is absolutely a participating lender. Okay, so is your credit score and FICO score the same thing? If not, what's the difference?
Okay, so from a lending perspective, it's a credit score. So I know from a buyer consumer scenario, when you go to pull your credit through Experian, TransUnion, CreditWise, Credit Karma, Expert, all those different entities, they break it down in regards to being a FICO score. But as far as the lender's concerned, is we pull all three credit bureaus, and they give us a score. And we take the high score out, we take the low score out, and we use the middle score to approve you to find out if you're eligible for a mortgage. And so FICO, I mean, to be honest with you, in regards to, that's actually the name of, it stands for Fair Isaac, and that's really underneath TransUnion. But I know sometimes people have kind of gotten that misconstrued as far as, your FICO score, your credit score. Really, it's your credit score. FICO is just one element of the credit bureau, TransUnion, as far as that's what they call their score themselves.
Got it. So how many lenders should you apply to when searching for a mortgage lender?
How many? I would say you probably shouldn't. I wouldn't, if I were in your shoes, I wouldn't do more than 3. Of course, it depends on the program that you're doing. If you're doing a program where, let's say we're doing with Invest Atlanta, and it is a program that is going to be the same because they dictate the interest rate and the terms and so forth, then, maybe reaching out to that many lenders would be a waste of your time. However, reaching out to that many lenders could be helpful because some of those other lenders may not get back to you quick enough. So I think it definitely makes sense for you to reach out to multiple lenders, but it's really based on who you feel comfortable with when you have that conversation, that they have your best interest at heart, that they're going to be communicating, they're going to be accessible to you, kind of what I mentioned. And that's kind of how I would think. But I think the rule of thumb, they say, is 3. And just so you know, if that happens, getting your credit pool is something that is okay with multiple lenders, because we've been told by the powers that be, which is the credit bureaus, that our bureau pools as mortgage lenders, we're all kind of counted as one in a given period of time, in a short period of time. So, if you do that, then don't think that's going to affect your credit. It shouldn't, because that's based on what they've told us. And so the other thing I want to pinpoint on that is that now you can get different scores from different lenders. And the reason for that mainly is because someone might have reported something on your credit report that wasn't reported on the credit report from another lender. Because I've had that a couple of times where I had to actually get the credit report and break it down to them because they didn't understand how one score could be higher or lower from one lender to the next. And it was just because something negative pulled on this other report that didn't report on someone else's report. Or sometimes it was stuff that had been paid down was showing up on one person's report, but it wasn't showing up on another's. And so that's just unfortunately a part of the game that we're all up against. And so it's nothing we can really do about that, other than if you have paid down debts, the lender should be able to do a rapid rescore to show your current balance, which would then hopefully increase your credit score.
Okay, so what do loan officers look for on a bank statement? Great question.
Loan officers look for it. Be honest with you, that's funny. That's a good question though. I rarely ever look at the bank statement. That may be not the right thing to say. What we're looking for though, what the processor is looking for, because I typically turn mine into my processor, they're looking for your income, right? And they're looking to see if there's any payments that are the same as last month. Because typically most of your payments are going to be on your credit report. However, there are some instances that you pay things that are required to be including your debt to income ratio that are on your bank statement that we wouldn't know about because they're not on your credit report. So they're looking for that. They're also looking for large deposits, large unsourced deposits. So deposits that may be outside the norm of your income level, they're going to be looking at those things because they want to know where that money came from. We need to source it. And sometimes, I just had one recently, got that same question. And of course, it didn't say that it was from the IRS. However, it was from the IRS. And so what we had to do is we had to get the check that he received and made a copy of that and wrote an explanation letter and turned that in to the underwriter. So those are kind of the main things that they're looking for. And then obviously they're looking at your balance. They're looking at your balance. And if you're in a position or you're at a spot where you've had some trouble in the past with, you know, I guess overcharges and things of that nature, those typically don't hurt you. But if you got a bunch of them, that's kind of a pattern in the past to where a lender may look at you differently, because if you are not able to handle your finances through your bank statement, more than likely will not be able to handle a mortgage. So that's something that could deter the underwriter from, you know, approving your loan.
Great. So do these programs extend into DeKalb County? So I will answer that. Invest Atlanta incentives can only be used in the city of Atlanta proper, so the incorporated city limits of Atlanta. However, I do believe that DeKalb County has a down payment assistance program. Whether it's currently funded or not, I'm not sure. Russell, do you know?
Yeah, we're actually a part of it. And to be honest with you, I haven't closed one in so long. It's called We DeKalb.
Yeah.
And I don't know the answer to that question. I don't know if it's currently funded.
Gotcha. Okay. So I'm going through a divorce. Do I need to wait until it's final before starting the loan process?
Yes, absolutely. Yes, you need to wait till it's final, because what the underwriter's gonna want the divorce decree, and of course, since you haven't finalized it, then you won't be able to turn it over, and it'll be an automatic denial.
Okay. Good evening. I had trouble logging on, or we had some folks that had trouble logging on, and I am so apologetic for that, guys. We're going to figure that out for next time. Hopefully, those that had trouble logging on have joined us on Facebook. So next question: what happens if you don't find a house within your 90 days of having your credit pulled and have to reapply? How does that affect your credit when reapplying?
Right. So that's actually a misconception. A lot of people, I've heard that a lot in my time as a loan officer, as far as the time frame. That to me sounds like one of those overlays I was talking about earlier. Fannie Mae, Freddie Mac, and FHA, they all say that we actually have 120 days before we have to repull your credit again. So if someone's saying 90 days, then that may be an overlay for that particular bank or lending institution. So we actually have 120 days. And so what happens after that 120-day mark, all a loan officer should do, they should verify that you're still gainfully employed by getting 2 more pay stubs at that time, and getting your permission to pull your credit again. And that then allows them to go ahead and issue an updated pre-approval letter, because they should have obviously all your other information. That stuff shouldn't change. And bank statements too. I'm sorry. Sometimes I will ask for bank statements. If I have a client that has $20,000 in the bank, I'm not going to ask for their bank statements. But if it was someone that was on the borderline of having the right amount of money to qualify, then typically that client, I will have to ask for that. And that's just because if they don't have that money anymore, they probably don't qualify. So it's very important that I do that.
Okay. How does applying for a mortgage affect your credit worthiness?
Give me that question one more time, please.
So how does applying for a mortgage affect your credit worthiness? I mean, how is that going to impact your credit, applying for a mortgage?
Yeah, so I definitely get that question a lot as well. I mean, here's the thing is that the credit bureaus, they understand that you have to apply for credit to get credit. And so it doesn't affect your score as much as people think that it does. There's a lot of myths out there about credit score and credit pulls and things like that. But as a rule, the credit bureaus, they break it down. There's 5 categories that determine what your credit score is. And the category that has the least impact is credit pulls. It's 10% of your score. So with that being said, unless you're running around, requesting credit from various industries, meaning if you just applied for a credit card a couple months ago, and then you applied for a car loan next month, and now you're applying for a mortgage loan with me, and your credit score is already below the national average, which is like 720, if you're like in a 680 or below range, that will probably have an effect on your score, because what they're trying to do is they're trying to stop you from going out and running up your credit, and you haven't shown credit worthiness because your credit score is a little bit lower. So that is kind of my take on that is really, if you have low credit, then it can hamper you if you're going through multiple sources outside of the mortgage industry. And so another thing I'll say to people that have great credit, because I get the question as well, if you have the 700 to 800 credit scores, having your credit score pulled multiple times, it will not affect your credit worthiness. All you have to do is explain why you had your credit pull. And again, it's because, that individuals with lower credit scores, they have a much higher default rate. I mean, it's astronomical, the difference. And so lenders and investors, they want to protect themselves to try to mitigate that risk as much as possible. So the credit bureau helps them do that by reducing their score if they're trying to get credit from multiple industries at the same time in a short period of time, like 90 days, 6 months, that type of thing.
Gotcha. Thanks. How long do you have to have a bank account open to buy a house?
Ooh, I haven't had that question in a long time. So you need to have 60 days. And if you're doing down payment assistance with InvestLine, you need to have 90 days. Is that correct?
That is.
Okay. So yeah, for a mortgage loan, 60 days, Invest Atlanta program is going to be 90 days.
Exactly. Okay. Can a person get down payment assistance without a 620 credit score? And I will answer that. And the answer is really yes. In some cases, it depends on which program you are selecting, but we do have some programs that allow the lender to determine the credit score. And if the lender says that they can qualify you for a loan with a 580 score, then we will take it. So it just depends on which program that you choose, because there are some programs that have a credit score requirement, and then there are some programs where we allow the lender to determine the credit score requirement.
Right. And so can I just kind of add to that?
Sure.
So for me as a loan officer, what I typically do in this situation, of course, I'm going to say, hey, go ahead and let me pre-approve you. Let me go ahead and pull your credit, because sometimes we're able to do what's called a rapid rescore to get you above the number that my minimum number is. But then sometimes it's not going to work out, or it can't happen. And you want a loan officer who's going to say, hey, you still should be a homeowner because you got everything else working for you. Let me get you to someone who can help you. And that's kind of, like I said, what I pride myself in. I pride myself in not just helping people that I can help, but helping whomever can be helped. And what that means is that, my minimum is 620. And I just recently referred 2 clients over to someone who's on Invest Atlanta's list because they can go down to 600. And that's the type of loan officer you want to deal with. You don't want a loan officer who's all for themselves and all about them. You want someone that, obviously wants to try to fix this, create a solution for the problem. But if they can't create a solution, then figure out another way to help you by getting you to someone, and someone that can do it. And that's, I say, a testament to being a part of these programs and going to these different events and stuff like that. A lot of the other top producers and other producers on the list, I've kind of talked to them and I know what they can do, so that if I ever have a client that I just can't help and they can do the program, then I refer you over to them. Because again, it's all about the whole industry. We want everyone to be homeowners. That's better for everybody.
Gotcha. Thank you. Okay, so I attended Q&A session in person in March 2019. Is that still valid, or do I have to attend another one? So what I'll say is that our Q&A sessions are good for 12 months. However, if you have recently taken it, we're going to, because of COVID-19, we're extending that to 18 months. But our Q&A sessions are available online. So if you've taken them before, you know that we used to have them in person in our office, and we are now obviously not able to do that. So the Q&As are eligible online. So please go and take it online. So yes, your current Q&A is over a year old. So just go take it again online. And then ultimately you're going to get a response from our teammate, Paige Mitchell, to indicate that you've taken it, and you will use that. You will provide that to your loan officer so that they will know that you've taken the Q&A in the proper time frame.
And can I add to that, Anita?
Yeah, for sure.
I think the other reason why you want to take, because things have changed. There's been a lot of different updates since March. And, I think the key to life in general is knowledge. And so the more knowledge you have, the better decision maker you'll be. So I think it's important to hopefully, take that time. I don't know how long it takes, but, hopefully carve out some time to do that, so that you're on top of what's going on today.
That's exactly right. And it's about 20 minutes. And so super, super easy. More fun in person, I'd say. We like to have some fun when y'all come to the office, but Obviously, we can't do that, so we've cut some things out. But it will get you the information that you need. So how much banking history do you require, Russell?
Yeah, so banking history is kind of the same thing with the question earlier. You got to have 60 days worth of bank statements, and that's not a lender requirement. That is Fannie, Freddie, FHA requirements. They require 60-day bank statements. So, as a rule for the mortgage loan, 60. And again, if we're looking at down payment assistance through Invest Atlanta, their programs require the 90 days. So that's the banking history. So, if you went in, deposited money into a bank account, last month, you're gonna have to wait at least another month, possibly two, to be able to get the down payment assistance to show that history. And there's no exception to that, or there's no way around that, because I've actually run into that before. Got to have the 60-day history or the 90-day history, depending upon the program.
Exactly. So what is the role of the underwriter on a loan?
Oh man, the role of the underwriter, they're the ones who actually make the decision on whether you're going to get
Or kill your dream. One of the
exactly. So basically, the loan officer is kind of the front man. And I didn't mention this, but I want to kind of throw this out there. I think the loan officer is basically an intermediary of the process between the lending institution and the borrower. And so, yes, I work for the lender. However, I'm more on your side than them because I'm trying to help you get a home. And that's the only way that it benefits both of us if you close. So I like to explain a lot of times it's us against them. And so when you're talking about the underwriter, they're the ones who is basically making the decision. And so, yeah, a loan originator can be very well versed and be very knowledgeable about what needs to be in the file and what needs to happen. However, the underwriter dictates exactly what they're going to accept. So sometimes you send in something, to kind of give you an example, it happens at all companies, but the guideline says someone that has a 401k loan, that they can either do monthly statements or quarterly statements. Well, obviously a company isn't going to do both. They're going to give you a quarterly and monthly. They're going to give one of the two. Well, I turn in the quarterly statements because that's what he gets. And so the underwriter was like, hey, no, we need a monthly statement because we want to make sure that money is still there. And I'm like, hey, Miss Underwriter, I get that. However, the guideline says all we need is a quarterly statement. And so, of course, she did not want to agree with me. So we had to go to her boss. And of course, her boss did agree with me because that's what the guideline says. So we were able to get around it. And so, I mean, the underwriter is there to protect the interest of the lending institution and the investor. Because obviously, if you, as a lender, when I say you, the lender, if they write 100 loans and 90 of them turn bad, default, the doors are going to close. And so the underwriter is to help protect. And don't get me wrong, sometimes it's a much smoother, easier process than others. But the key is, I think I mentioned it earlier, is that you want to deal with a lender that doesn't have a lot of overlays, because then there's not a lot of gray area for the underwriter to say they need this or they need that, or make the process a little bit tougher. For the vast majority of them, they're definitely trying to get you into the home. However, they have rules and regulations they have to stand by. And so, when they're making those decisions, sometimes it seems like it may be a little tough. But the good news, a lot of times you can get around it if the loan officer is steadfast and they're guideline oriented, they can make that work for you.
Gotcha. Okay, so P. Rail says, I've worked in the same field for 10 years, but my current job for 9 months. How long do you have to be working on the current job?
The day you started. Yeah, you can switch industries. Yeah, you don't. There's no time frame as long as you're gainfully employed. That's what the investors care about. And the underwriter.
And the gap, correct? And the gap.
If there's no gap, then we're good. So meaning if you left that job and then you started the new job, then you're good. And even if there's a gap, we still can possibly make it work. We just gotta have an explanation of why. And sometimes it may be, hey, they let go, they downsize, and then it took me 3 months to get a job. You write an explanation letter for that, and we're fine. And so, to answer your question, no, there's no specific time frame. I mean, realistically, you could have bought with the offer letter that you received. You do have to typically at least get one paycheck stub as far as the lender's concerned. And then, of course, we'd have to talk. If you're talking about down payment assistance, that's where Anita and her team comes in. We'd have to ask them if that would be enough, if one pay stub would be enough, and kind of go from there. But from a lending standpoint and the investor, all they care about is you're employed and that they can verify that you're making money through your employer, and we're good.
Okay. Can you explain what escrow is, please, sir?
Oh yeah, for sure. Escrow. So escrow is a part of the transaction that most lenders require, and that is setting aside money to pay for your property taxes and your homeowner's insurance. Okay, so your homeowner's insurance is something that's required that you pay, just like your car insurance. To cover your car, you got to have homeowner's insurance to cover your home for damages, fire, whatever the case may be, because the lender is giving you a large sum of money and they need to be protected in case of something happening to your home, on a grand scale. And so they require you to have homeowners insurance to do that. And so most lenders, depending upon how much money you put down, but if you're not putting down 20%, then the lender is going to require that the escrow be set up on your mortgage loan. And so the escrow, homeowners insurance, and property taxes is broken down. All we do is we divide what your annual amount is by 12, and that gets added to the mortgage payment. So let's talk about the mortgage payment. The mortgage payment breakdown is first principal and interest. And the principal and interest is your term of your loan, 30-year, 20-year, whatever, your interest rate, and your loan amount. And that all computes to a specific principal and interest payment. And then you're going to have your homeowner's insurance. And let's just say your homeowner's insurance is $1,200 a year. Well, that divides down to be $100. So then I would add $100 to that payment. And let's just say your property taxes are $3,600 a year. Well, we divide that by 12, that's $300. So now we've added $100 and $300 to your principal and interest. And that money that you're making a monthly payment every month is set aside in an escrow account to pay those for the next year. So when you close on your loan for your homeowner's insurance, you're actually going to be paying the first full year up front that's part of the prepays that I pointed out earlier. It's part of your prepays that you have to pay. And so that pays you from, the day you close to the next year, a year from now, from that day you close. And then as you make those mortgage payments every month, they're taking out that $100 and setting it aside in an account. So when it comes 2021 and 2022 comes up, they can go ahead and pay that bill so you're good for the next year. And that's the same concept with your property taxes. Property taxes come due at the end of the year. They're going to take out a certain amount of money at closing to put into the account so that as you make your mortgage payments, they can take out that monthly money every month. The monthly money combined with your money that was set up in escrow when you close, that money should be enough to pay the property taxes at that time when they're due. And so that's the definition of escrow. They're basically setting aside your money to pay your property taxes and your homeowner's insurance at a later date.
Alrighty. So what credit score is too low to have when trying to purchase a mortgage?
Okay, so I would say I know some lenders still going down to a 580, and so anything below that I would say is too low for various reasons. Because typically when you have a low credit score, the reason why you have a low credit score is because you have not shown your credit worthiness, and so lenders don't want to lend hundreds and hundreds of thousands of dollars to someone who hasn't been able to show that. So anything below 580 is going to be tough. And even at 580 in this current market is going to be tough because the interest rate is going to not be what you're seeing that everyone else is getting. It's going to be very high to the point of where it may not even be available. Somebody may offer 580 as a lender, but the investor on the back end rate is so high that you can't even do the loan. And so to answer that question, I would say you want to at least be at 600. But again, it can be done at 580 for the most part.
Great, thank you. So would you suggest having one account for savings, escrow, down payment, and another account for everyday spending or bills?
Nope, I would say have one account because that escrow account is going to be set up with the lender. So that will not be coming out of your funds. It'll be including your mortgage payment. So when you make your mortgage payment, they're going to take out the escrow from that. So kind of give you an idea, your principal interest is $1,000, your homeowner's insurance $100, your property taxes are $100. So you're paying $1,200 a month when you pay your mortgage payment, and they're going to take that $100 out and the other $100 out to set aside to pay your escrow account. So
Right.
you having one account is perfectly fine. You don't have to have multiple accounts in regards to your savings or checking or anything like that.
Right. Not necessary. I think it might be easier though to push your money, your savings over to an account that you're not messing with every day.
Correct. Yeah, for sure. Because as human beings, you know,
Right.
we're spenders. We're spenders. So if you set it aside as something you don't see, more than likely you won't touch it unless it's an emergency. So I definitely 100% agree with that for sure.
All right. So how do you determine when it makes more sense to go with an FHA loan versus a conventional loan?
Okay, that's a great question. So typically what I do for my clients is I always take them the conventional route first. We try that first. The reason why is because I've never, ever heard of anyone refinancing to an FHA loan. People typically always want to refinance to a conventional loan. Why? Is because conventional has options at certain points of how much equity you have that you don't have to pay PMI. And FHA's setup is that you have to. Okay, PMI is private mortgage insurance. And so this is an amount that gets added to your monthly mortgage payment if you're not able to put down 20%. And it's protection for the lender because, again, people that don't put down 20% or more, the default rate is higher on those individuals. So lenders, Fannie Mae, Freddie Mac, require that you do have PMI on your loan if you're not putting down 20%. And so if you're not putting down 20% and you have PMI, that's going to be attached to your payment. What was it? Could you confirm that question again to make sure I answered it all?
Yeah, it was just how to determine when it makes more sense to go FHA or conventional.
Right. So to kind of further that information is that we want to start conventional, and for that reason that I mentioned to you, and that's really the main reason. Because if you can get a mortgage right now, rates are the lowest they've ever been in history. So if you can get a conventional rate in the 3s, and obviously if you're doing a loan that you have your own money or whatever, you could do in the 2s on a 15-year, but just talking about 30-year fix, you can get in the 3s. That's something that you may never need to refinance again. And so I want to put people in loans where they don't have to touch it so they can focus on getting it paid off as quick as possible. Because we all know that's probably the quickest way, besides owning your own business, to create wealth for you and your family is to get equity and sell your home at a premium. And so to be able to do that, you want to have a low interest rate, right? Because it helps you put more towards the principal so that the loan pays down faster. So typically conventional is where we start. And then FHA is the loan where you may have a client that has some issues in the past, meaning, tons of collections, charge-offs, bankruptcy, past foreclosure. You can buy a home quicker by using the FHA than conventional, and even lower credit score. So FHA is there for individuals whose credit scores may not be that great. And even though conventional's minimum credit score is a 620, not everybody at 620 qualifies. But a lot of times what we do is we'll take that client FHA and they do qualify FHA. So that's kind of the main reasons behind why you would choose one or the other. And then sometimes, I've had it with Invest Atlanta that the rate on the FHA was a little bit lower. So the client really wanted that rate, even though the PMI was for the life of the loan. So it's going to be a breakdown of, your knowledge. And again, the lender giving you as much information as possible and breaking it down, saying, hey, here are your options. What do you think is best for you? Unless you only have one option, then that typically will be FHA. Unless, I know there's a lot of unless, but if you're talking student loans, then conventional typically is the better route to go.
Gotcha. Okay, so if you have multiple bank accounts, would you need to submit all of your bank statements or just your main checking and savings?
Submit it all, baby. Submit it all. Like I'm a firm believer in giving me everything so that I can make sure this process is smooth and easy as possible. And so I think that the times that I've gotten clients that not send me everything, as a matter of fact, I'm dealing with a client right now where the numbers changed through the processing of the loan, and he needed some more assets. And so I'm racking my brain trying to figure out how to get this done. And I called him up and I said, hey, we have a problem. I mean, your asset, things came back. You have to pay this. You have to pay that. You had to give me an updated bank statement during the process of this loan. You had 11 grand in your account. Now you only got 8. Now you don't have enough money to close the loan. And I'm like, do you have any other accounts? He's like, oh, I got 3 other accounts. I'm like, oh, wow, that's great. I've been trying to figure out how to make this work for you. Had I had that information, I wouldn't, I'd have turned it in and ahead of schedule, and we wouldn't have to go back and forth with the underwriter to try to make this loan work. So I think it's important to turn it all in, because a lot of the stuff that you turn in, the lender may not even use. However, it gives me the ability to figure out the best solution to make your loan as smooth as possible.
Okay, quick question. If you have, and I'm not sure you're going to be able to answer this, but I'm going to throw it out here. If you have a fairly new FHA mortgage, less than 3 years, and you get laid off because of COVID-19 and now are in forbearance, how long will I have to get another job or wait for Social Security benefits to start?
Okay, so actually there is a little bit of guidance on it. Are you talking about refinancing? Because they own the home, right? Is that what he's saying?
It sounds like they do.
Okay, so they own the home. What we're being told is that the government came out with some guidance that says that they want you to be able to take advantage of lowering your mortgage payment. I do think you do have to have gainful employment. You do have to have income coming in, but once that income comes in, then the lender should be able to move forward with refinancing your mortgage.
Okay. All right. So will lenders require more years of proof of income since buyers have had a drastic reduction in income due to COVID-19?
Yeah. So what's going to happen with that is, first off, we're going to see if you qualify with the reduction. If you don't qualify with the reduction, then they're going to, then we can look out. Well, I guess we can now say we can find out and ask the question: when has your company said they're thinking about you going back to the full-time employment, full-time income, and then we can make a decision based on that if that's going to work out for you in regards to qualifying for a mortgage. I guess the big takeaway is that we have to go by what you're currently making. But if we find out that, hey, that's going to change in a matter of time coming up soon, then we can potentially move forward based on the knowledge that that's going to be changing soon. But I guess to answer your question, we have to go by what you're currently making. And so there is no specific time frame. So if 6 months from now, you start getting back your regular pay, we can use that. We can use it immediately. Once you start making your regular pay or whatever that is, then we can use it immediately. You don't have to have made it for 6 months or a year or anything like that.
Okay. So the second part of that question was, do you anticipate Invest Atlanta programs, assistance programs, income limit requirements to change in 2021 due to COVID-19? I'll quickly answer that. We expect income limits to change in 2021 because HUD income limits will change. They change every year. Those income limit changes won't have anything to do with COVID-19. Two-part question: if you are pre-approved, how long does the pre-approval last? And secondly, can you open new lines of credit after obtaining the pre-approval? That's a good question.
Yeah, that's a great question. So typically, again, most lenders should be telling you it should last for 120 days because that's how long the credit report before it expires. I know someone mentioned 90 days here earlier, but most of your lenders are going to be 120. Every lender I've ever worked for is 120 days because that's what Fannie Mae, Freddie Mac, and FHA and VA, USDA, that's what they say that we can go up to. Again, if they spend less time than that, then that's something that company is kind of overlaid. That's kind of what they think is best for their company. The second part of that question, what was the question to that? It was about
can you open new lines of credit?
Yeah, no, we want to stay away from opening any new lines of credit unless it's absolutely imperative for life, your health or something like that. But if it's something that, get my furniture ready because I'm going to be moving in the house, no, we don't want to do that. If it's a situation where, my car died on me, I got to be able to get to work, we need to have a discussion. So that's kind of that communication piece I was talking about earlier, because it's possible, but we don't want to just go out and say, okay, I know in my mind I can afford a $500 payment. On paper, you may not be able to afford a $500 payment. So it's a question, or it's a situation where you want to get with your lender and have that real conversation saying, hey, this is what's going on because I need to absolutely do this. Just doing things because, let's say I had a client say, well, I got this offer for a 0% interest rate and I want to switch my balances over. No, We got to wait on that. Let's wait on that, because all that's going to do is cause more for everyone to do, turmoil and delays and things like that. And we want to try to make this process as smooth as possible.
Exactly. Okay, so Russell, it is 7:30. We have until 8 o'clock. I'm going to start moving a little faster on these questions, and
Okay.
your responses are going to be a little bit faster as well, so that we can
Okay.
get through all the questions.
Yep.
Because I don't want to leave anybody hanging. Okay.
Okay.
Are you able to purchase a home with state tax lien?
Yes, they're going to have to be paid off, though. They got that's part of the seller's side of the equation. They're going to have to pay those off.
Okay. How many months of bank statements are reviewed? We've covered that. Can you purchase a home if you're legally separated? That's a good
Yes.
question.
Yes, you got to
Okay.
all you got to do is turn in the legal separation papers with the normal
Okay.
paperwork that the lender will request.
Okay. What is the income limit to qualify for down payment assistance? So guys, there've been a lot of down payment assistance questions. We are doing the down payment assistance session on the 23rd, I believe it is. Michelle will post those dates before we end. But our 4th session is on down payment assistance. We're going to go over all of that. Okay. Can you have more than one FHA loan at a time?
Yes. There's specific guidelines that I don't remember off the top of my head, but there's 3 guidelines. I know one of them is change in family size. One of them is change in location as far as the distance between the 2 homes. And I don't quite remember the other one, but that's something that I can easily look up, and any lender should be able to easily look up that guideline. But the answer is yes.
Okay, because there are a limited number of affordable homes in the Atlanta area, does Invest Atlanta have, okay, so I'm not answering any Invest Atlanta questions right now, because we want to get through these lending questions. Q&A, definitely more fun in person. Thanks, we appreciate that. Does down payment assistance? Nope, nope, nope. Does age have an effect on approval of a mortgage loan?
Age. No. Now, if you're talking about actual like the age of the person, then no. You just have to be able to sign a contract. And I think that legal age is 18 in the United States. So if you're 18 years old and you show 2-year work history, you have money in the bank, you have the assets, you have the credit, then you can buy a home.
Great. Okay. Does your mortgage payment change if property taxes increase or decrease? Great question.
Yes. Yes, that is a good question. Yes, they will change because what's going to happen is that the lender is going to get a tax bill that's different from what they've been collecting. And so they're going to pay that tax bill, and then they're going to do an escrow analysis, which is required once a year by the government for it to be sent out to you. And that extra analysis is going to break down what they paid and how that affects your payment. And sometimes they offer a lump sum payment, and then sometimes they'll stroke it over a 12-month payment so that it can break down to an easier amount for you to handle. But yes, it will increase or decrease.
And same thing with insurance. Insurance will cause your payment to go up as well. With rates at an all-time low, are there any benefits to getting a 15-year mortgage versus a 30-year?
Okay, so if we're talking down payment assistance only allows 30-year fixed. And if we're talking about you're putting down your own money, there's definitely some advantages because you get to pay that mortgage off much quicker. You build equity much quicker. Anything that's going on in the world as far as equity is concerned, when you're doing a 15-year, you kind of get around that. In quick stories, I had a client that did a 15-year during the crash back in 2008, prior to the 2008 crash. And he calls me up and he's like, hey, I want to do cash out. And I'm like, no one's taking cash out of their home because, people are underwater. Well, the reason why he was able to take cash out is because he did a 15-year and he only had 5 years left. So his equity position was so great because so much money was going towards principal. He was able to still have equity even in a terrible down market. So yeah, 15-year, if you can handle it in your budget, I implore everyone that can handle in their budget to do a 15-year. That's the best option for you to gain wealth and gain, being out of debt the quickest, because typically your mortgage is going to be the biggest payment that you have in your life.
Okay, can you get a loan for 80% of the value of the home and another loan for the rest in order to avoid PMI?
Yes, there are certain instances that's allowed it's called a home equity line credit or a standard second. You can do 80-15, you can do an 80-10, and what that basically means is that you'll get the 80% mortgage loan through Fannie Mae or Freddie Mac to avoid MI, and then you'll have a second mortgage that you have to pay back at a certain interest rate at a certain payment over a certain period of time. So it is possible.
Okay. If someone has rented a place for 11 years and has never missed or paid late, do lenders take that into consideration when your credit specifically is at a lower credit score?
One more time, please.
Okay, so if someone has rented a place for 11 years and has never missed a payment or been late, do lenders take that into consideration when their credit score is lower?
No, they don't. Because the thing is, with credit, they expect you not to miss payments. But if you're trying to build a case because you don't have enough credit, that's different. Yes, they will take that into consideration, but we have to prove that you've done that. And if you're doing that with a business like an apartment complex or a corporation that's renting a house, then that's usable. If it is your cousin or your auntie that's not a corporation, they don't accept that because they feel like that person would just make it up to help you get the house. So yes,
Right.
The answer is it is possible for it to be used in the situation of, but you're using that because you don't have enough credit, not because you have bad credit, but you don't have enough credit on your credit report.
Let me ask this, Russell, with your bank, if they are renting from their aunt or their cousin and they write a check and they can give you 12 months canceled checks for that rent, will you accept that?
Yes, because that's provable. The only problem is I've never seen it.
Right.
I've never seen anyone, because
There's
the thing
always
is, a lot of times,
missing check.
yeah, it's just a tough, but yeah, it is possible for sure. Yes.
Okay, so is there a prepayment penalty to pay off your FHA mortgage early before the 30 years?
No, there are no prepayment penalties on any traditional loans, meaning conventional Fannie Mae, Freddie Mac, FHA, VA, USDA. It's against the law.
Right. And so Dee, that should answer your question as well. If you had a 30-year loan and you paid it off in 15 years, there would not be any prepayment penalty. Okay, so I'm going to jump over here to my Facebook Live questions, guys. Let me make sure I get all of those for you. All right, so concerning COVID, what will happen with the lender piece if you were laid off temporarily due to the shutdown?
Yeah, so if you're in the process of being pre-approved, or if you're pre-approved, or if you're in the process with a mortgage loan, the answer to that question is that they're gonna suspend or hold your file until you go back to work. You're gonna need to be actually gainfully employed in order to purchase a home or continue on with your pre-approval. And of course, how you prove that is with pay stubs.
Right. Okay. So I think this question needs some clarification, but I think I get it. So she says, what you put down is able to count as a point pay down. And that's no.
Yes. Yeah. So what you put down, you can use that money to buy down the rate if you're doing a traditional loan. And in some loans with Invest Atlanta, some of their programs require you to accept whatever the rate of the program, and there is no buy down. So it doesn't matter if you have a 660 credit score or if you have an 820 credit score, you're getting the rate of the program. And I think the last FHA that I closed here actually I'm getting ready to close, the rate we locked them in at was 2.75 on a 30-year fix, which obviously is a tremendously great rate.
Russell, though, I think just for more clarification, your down payment is not the same as what you're going to pay to buy down the rate. The points you pay to buy down the rate.
No.
You're going to have a down payment requirement, and then you can then pay some additional funds on top of that to buy down.
Okay. Yeah, I see it. I get you. Okay, so the breakdown of that is that when you're doing a down payment, whatever you're putting down, it may be more than that at closing. And so meaning that you're required to put down a certain amount, whether you're doing an FHA loan or a conventional loan. And then you're also required to pay closing costs. And if the seller isn't covering those closing costs or prepays, then you're going to be required to bring those funds as well, in addition to the down payment. And so buying down the rate is considered a closing cost. So that falls under that category. Okay, so if your closing costs are not being fully covered, or your prepaids are not being fully covered by the seller, then you have to bring that on top of the down payment.
Gotcha.
Hopefully that answers the question.
Yeah, I think it did. Mr. Elam, you mentioned something about rehab loans. I didn't catch it. Are there still lenders that will provide rehab loans? And I didn't say that in your bio, so please tell the people.
No, unfortunately, I'm going to say no to that answer, just because the investors, it's not necessarily the lenders in this situation, is the investors pulled out. Rehab loans,
Due to COVID, though.
due to COVID-19, investors pulled out of that because it has, unfortunately, it just has a high default rate. And so investors moved away from that for the time being. I do think it's going to come back at some point for sure. It's just that right now, most of your investors are kind of shied away from that.
Okay, so for those whose jobs were affected by COVID and will be headed back to work with new employment, the loan officers look for potential home buyers to have worked in a single field for a certain amount of time. And I think we've answered that. You've already established that no, you don't have to be in the same field.
Right, that's correct.
Okay. Okay, that's DPA. Yes, Invest Atlanta is still offering. Oh, Kirsten, my girl Kirsten got on here and was answering some questions. Because of student loans. And so guys, I'm not necessarily ignoring the DPA questions, but I am for the sake of time. Because the student loan payments have stopped until October for COVID, does it negatively affect your credit?
No, it does not. Actually, it's been helping a lot of buyers, because what a lender wants to see, they need a statement showing what your payment is. And for a conventional loan, if you provide the lender, the loan officer, with a statement that says the payment is zero, under conventional guidelines, they have to accept that zero payment. So it's actually kind of been a benefit to some of the buyers out there, because some of them, are doing an income-based payment, and they even, move those to zero. So that person might have been paying $150, but now they just provided me with a statement that says zero. Well, I'm going to use a zero, even though I pre-approved them with 150. So in that case, it's definitely been a benefit to help individuals. However, again, if you're doing a in-school deferment, or if your student loan is deferred or in forbearance, you're still in the same boat. You will not get credit for the zero payment, because you never actually were making a payment. You never had a scheduled payment. So the key is, with student loans, you have to have a scheduled payment. Even if it's zero for conventional, they will accept it.
Great. Is there a difference in PMI and escrow? We answered that. I think we should be very clear on that. Does down payment assistance count toward the 20%? Yes, sorry. Isn't it true that FHA loans are not recommended for buyers with higher student loan balances?
Yeah, that's going to be the case. Again, the reason why is because as lenders and loan officers, we have to take 1% of the balance. So let's say you have $500,000 in student loans. 1% of that is going to be $5,000. Even though we know, that you're not making that payment, FHA requires the lender to input that in as the payment. And of course, that typically will put you in a position where you don't qualify for an FHA loan. However, I did mention that there is a way around it, by finding out what the actual standard payment is, because the standard payment would not be $5,000. It may be $2,000 or $3,000, but obviously that's a big difference. So the key on that is that you want to speak to your lender loan officer to find out, do they understand that scenario and how to work that? Because again, I've talked to a lot of clients in the past where I was able to save their loan because their lender didn't realize that they could call and ask for, the standard payment. Now, the other part of that is you ask for the standard payment, and then I use that to figure out if you qualify. You're going to need to set that payment up in order to get the mortgage. So it's not just on paper. You're going to have to set it up so that it says that, hey, this is your new payment and it's due at whatever date in the future, in the near future. And so, we can have a conversation. You can email me, kind of talk about that further, because then, I think that's important to understand that.
Okay, so how does the qualification requirements for purchasing a multifamily property versus a single family property differ?
Great question. So it differs in the fact that if you're doing a conventional loan, you're required to put down a lot more money. FHA is typically the route that most of us take you, because they look at a multiple unit property as a single family residence. And so they're not requiring you to put down a ton more money like conventional is. So that's really the biggest difference. When you're doing multiple units, a lot of times they like to have a little bit of assets as well. And on top of that, depending upon the multiple unit, you may be able to use the income if they already currently have people renting, 1 or 2 units of, if you're doing a duplex or a triplex or something like that, you could potentially use the income. So that's something else that I want to kind of just throw out there to help you qualify for a multi-unit scenario. But just remember, if we're talking down payment assistance and we use that income, then that counts against your income requirement for the program.
Okay, what is a USDA loan?
USDA loan, that is for if you want to live out in the sticks. So if you want to live out in the country with the one stoplight type scenarios, then the USDA loan is where you're going. Seriously, they have a website that you can go in and put an address in, and it'll tell you if you qualify. But it's definitely nowhere in the Metro Atlanta area. You got to be on the outskirts of town. A lot of trees, a lot of field. So that's kind of what you're looking at for USDA loan. So USDA loan is 100% rural loan. So you got to live in the rural areas.
Gotcha. Levi asks concerning VA loans, does the lender look down and what's the process? So I'm going to say no. I'm just going to say no. The lender absolutely does not look down on the VA loan, and the process is exactly the same. And a VA loan can be used with Invest Atlanta incentives as well. Sorry. COVID furloughed as of 3/21 with said date to return in July. Applying afterward in the next few months, I'm asking, is that going to hinder my process when it begins?
The question was applying now because of.
No, he's applying after. He's applying after. So he's going back to work in July. He's been furloughed as of 3/21, going back to work in July. So about a 3-4 month gap, applying afterward in the next few months after being back on the job. So how's that going to impact him?
It won't. Again, it's one of those situations where what you want to do is go ahead and write up your explanation letter on why. And obviously we all know what's going on with COVID-19. So you just write that in an explanation letter. And once you get that first paycheck or a couple paychecks, whatever, if you're salaried, then it's easy to compute. If you're hourly, it's probably a little bit tougher unless your employer is guaranteeing that you make your 35 hours a week or 40 hours a week or whatever it is. But we will be able to use your income and we will be able to move forward as if nothing happened. It's just a matter of how do we compute the income based on how you get paid.
Gotcha. All right, guys, I think we have come to the end of all of the questions outside of the down payment assistance questions. However, I see that my colleagues, Kirsten and Michelle, have, I think and hope, answered all of them. And so I think Michelle says maybe not.
It's difficult for me to toggle between the two, so I got to a couple of them, but after this is over, we can go through and answer those questions that are related to Invest Atlanta. What I am going to do is share the screen that shows the next 2 classes that are available next Tuesday and the Tuesday after, so that you can register for those or just come back to Facebook Live for those of you guys that are on Facebook next Tuesday at 6. And I'm also going to send out to everyone the PowerPoint presentation, Russell's contact information, and that's it, I think.
Yes, so thank you guys. Absolutely. Thank you so much, Michelle. Thank you guys for being here. It's wonderful to see. I think between Facebook Live and Zoom, over 100 people joined us today. So we really appreciate that and hope you got the most out of the information. And please plan to join us again next week and the week after. Thanks so much, Michelle, Kirsten, Russell. Thank you guys for being here. You guys all have a great night.
Thanks, guys.
Thank you all. Good night.
You're welcome. Thank you.
Bye. Oh, and thank you, Felicia. Lift you out.
Hello.
Hey.
Hello.
Hi.
Hi, I have a question. I guess I missed the Q&A session, the first part of this. Is there any way I can go back and get that or attend an upcoming session?
The Q&A session wasn't a part of this
Okay.
seminar. You're welcome to visit our website and take the Q&A anytime. It's about a 20-minute YouTube video.
Okay.
It's followed by a quick quiz.
Okay.
And it basically sums up our portion of the home buying process and our incentives. Or you can also come back to Facebook on, it's actually the 23rd.
Okay.
I will send out an updated, this is saying the 16th. It's actually the 23rd, but I'm gonna send everybody out just a packet so that you know what's coming up and how to reach Russell. And I'll even include a link to our Q&A session on our website.
Okay, perfect. Thank you.
You're welcome.
All right, I enjoyed
here.
everything. Thanks again.
Thank you.
All right, have a great night, Michelle.
Ladies.
Say that again,
Get
Anita.
out of this. I don't know how to get out.
Oh, just there's a little
Okay, I
red
see it.
phone button. You see it?
I see it. Yes, thank
Okay.
you.
Hi, you're welcome.
Bye-bye.
Bye-bye, y'all. Good night.
Thanks, Michelle. I think we're good. That was great.
Yeah, what you might want to do though is look at what you sent over to Atlanta Voice though, because this has the 16th on both those dates. And that's where I pulled this from.
I haven't even sent it to them yet. But
Okay,
yes.
good.
Okay.
Good,
All
good.
righty.
Awesome.
Okay. Thanks so much. I appreciate it.
All right,
Have a
about
good
to
night.
run to the
Good
poll.
night, ladies.
Good night.
Good
night.
night. Thanks.
Good night.